we were tempted to call the panel a bit more provocative, low for longer or low forever. We didn't do it because I do think that many of the banks the central banks are looking at the current level of interest rates as having done a turnaround in monetary policy. A year ago when we were here, we still talked about Fed long-term rates being rising, and we talked about the US Treasury 10-year being at 3% and slightly above. Now we're 150 basis points lower than that. And so it was quite an unprecedented fast turnaround in monetary policy. Many of the central banks have basically portrayed this move as a correction of their stance, a reversal and a correction, rather than a new massive move into QE. And you can see that with the size of the rate cuts that we've seen, or with the size of the re-embarkment of the ECB in purchases. But clearly this environment is going to be around for a very long time, and therefore investors need to find a new investment paradigm for such a low for long interest rate environments. And you can see that with bond markets. I mean, bond markets, yes, you get a very low or even negative return, but bond prices have actually rallied because this environment is expected to stay for longer. So if you're looking at valuation effects rather than looking at return, you do actually look at bond markets as something where you're getting valuation easier than with equity markets in many areas.
On a relative basis. So these days everything has to be priced relatively. Do you think that we've got to the point now where the onus has to be on fiscal policy? That is the only savior in the room that can help really shift the investment landscape and help get us off negative interest rates?
Well, that was a discussion. This is now my 8th UBS conference here in London, and I think over most of them the discussion was central banks have done their part, fiscal policy, structural policies need to take their place. They've been calling on fiscal policymakers more urgently recently at the ECB and in other constituencies, but what we haven't seen is policymakers stepping up their fiscal game, and that's largely because in Europe they're out of space. Fiscal policy is at the limits of the 3% deficit criterion. Debt levels have risen massively. So whilst monetary policy has very little room left to move, fiscal policy doesn't have a lot of space. There are a few countries.
Depending on the country,
yeah,
obviously.
there are a few countries like Germany that do.
Maybe it's just time to change the rules then. I mean, this hasn't worked. It's not boosting productivity. We've seen subpar growth out of the Eurozone for the last couple of years. Maybe it's time to reevaluate all of those rules to give the Eurozone a chance to grow in line with the rest of the world.
But I think on the Eurozone growth, what is important is don't just look at fiscal and monetary, look at structural. And I think that's where we've seen a lack of action on the European side. Look at Brazil. We had a panelist from Brazil in the last panel, and she was talking, she's the deputy of the Banco do Brazil, the central bank, and she was talking a lot about how the current government is enacting reforms that will basically make a more dynamic economy, and that's what Europe needs. Europe doesn't have a short-term growth problem. Europe has a long-term growth problem. There is still massive unemployment rate. There is infrastructure that has not been reinvested in for many years. And now that funding is available cheaply, you can combine the fiscal and the structural and do infrastructure and many other investments that would help the economy grow and regain growth long-term rather than just a short-term consumption offset. And that's where the debate needs to go, really enabling investments and infrastructure and sustainability, which is a new development that is becoming more and more powerful, and really re-gear your efforts there.
Unfortunately, you probably need to see economic situation deteriorate further to spur a lot of these governments into action, because right now you have growth sort of averaging 1%. No one's really feeling the pressure. There's no recession.
That's right, but partly the recession risk has been taken off the table by the central bank's action who moved from tightening to easing, but there are underlying long-term trends like demographics. The decline in growth in general is part of a reflection of that long-term demographic problem Europe has. Real interest rates have come down over many, many years. There is an issue about technology and technological innovation. So I think Europe has to basically focus again on what is needed in the long term rather than plugging short-term problems. And infrastructure is one. There's a whole debate in Europe now about, the new technology requires a 5G network. It requires, many of the new technologies are available, but then they're not implemented. And that's where I think the focus will shift. In Germany, you can combine a fiscal policy that is more expansionary policy with a environmental topic like changing the age and the environmental friendliness of the fleet of cars that is on the street. That's what they did in 2008, 2009, and that's probably coming up on the agenda again. Let me tell you that half the growth slowdown is related to auto. We just worked that out on the last panel. If half of the growth slowdown is related to auto, doing something targeted that makes an environmental friendly and positive transformation of the automobile industry is something that will help demand and supply in that area. So policymakers should look at these levers more seriously.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.